Hello. Welcome back to Chapter 9 for Business Mathematics. So, in the first part of Chapter 9, we focused on how to determine an employee's gross pay. Yes, that was fun, calculating regular earnings as well as your overtime earning. But now we must look at deductions from gross pay to get to your net pay amount or your take home pay. Let's take our employee Joanne, who earned for the week $2,450. She's on salary, so there's no overtime compensation. A is showing M2, marriage status and two allowances. We'll discuss that in a few. B is showing the amount of money she's earned before this pay period. C is showing how much money she earned for the current pay period. Again, there's no overtime because she's on salary, exempt from receiving overtime. And E is showing how much money she's earned in total year to date. And we'll discuss why that's important. F is showing how much of the amount earned this week is taxable for Social Security tax. And G is showing how much is taxable when it comes to paying the Medicare tax. H and I show deductions for Social Security tax, deduction for Medicare tax. J shows deduction for federal income taxes. K deductions for state income taxes. L shows deduction for the health insurance premium. And we get done with all of those deductions, we get to column M, which shows the net pay for Joanne, or her take-home pay, has been $1,718.46. You're probably saying, wow, those are a lot of deductions from gross pay to get to her net pay amount. Okay? I'm going to first talk a little bit about FICA, taxable earning. So FICA stands for the Federal Insurance Contribution Act. Again, FICA stands for the Federal Insurance Contribution Act. There are two types of taxes imposed on employees and the employer because of this act passed way back in the late 1930s. The first tax is Social Security. The second tax is Medicare. As an employee, we're required to pay these taxes each pay period because of the Federal Insurance Contribution Act. Now, notice that although the employee earned $2,450, for Social Security tax, it says the tax amount is going to be $900. That's because Social Security has what's called a maximum earnings base, which simply means that if you reach the maximum earning base, you're not required to pay Social Security taxes for the remainder of that tax year. You're like, what? Yep, that's the law. So Congress sets the Social Security maximum earnings base, and if you are fortunate to reach that maximum earnings base, what it means is that you're not required to pay Social Security tax for the remainder of the year. So Joanne had earned before this pay period $117,600. The earnings base is $118,500, meaning that you only pay Social Security tax on your first $118,500 earned. Now the earning base changes every year, and this is not the current earnings base, but we use this for our illustration. Joanne has earned for the year $120,050, but not this entire amount would be taxable. So again, Social Security tax, the tax is only imposed on the first $118,500 earned for each employee. Because she's been taxed on $117,600 already, of the $2,450 earned this pay period, only $900 is taxable. Because if you add $900 to the $117,600, that gets you to the max earning base of $118,500. So yes, she earned $2,450 this week, But of that, for Social Security tax, only $900 is going to be taxable. Medicare does not have a maximum earnings base. Therefore, the gross amount earned each pay period will be taxable when it comes to paying the Medicare tax. And now here you have the tax rates. To get the deduction for Social Security tax, take the taxable earnings, 900 times 6.2%. That would give you $55.80. For the Medicare tax deduction, take your taxable earnings, the entire $2,450 times 1.45% to get a Medicare tax deduction of $35.53. So once you determine the amount of taxable earnings for Social Security tax and for Medicare tax, you're going to multiply times the applicable tax rate to get the deduction for the Social Security tax and deduction for the Medicare tax. Okay? Next up, we have the income taxes, federal as well as the state income taxes. We're going to mainly focus on the federal income taxes because the state income tax laws vary from state to state. There are certain states that do not charge a state income tax, such as Texas, Florida, Nevada. They do not charge a state income tax. So we're going to focus mainly here on the federal income taxes. Okay? So when you are first hired, one of the first forms you fill out is called a W-4 form, Employees Withholding Allowance Certificate. This form indicates the number of allowances you're claiming, and it also shows your marital status. Yes, your marital status does have an impact on the amount you have withheld for federal income taxes. If you're single, you're taxed at one rate. If you're married, you're taxed at a different rate. Hey, I understand. Don't get mad at me. I did not make the rules. My job is just to provide you with the information. Okay? So when you saw this M2 for Joanne, that means that she's married and she's claiming two allowances. So again, this has an impact on the amount you will have withheld for federal and if applicable, also your state income taxes. The more allowances you claim, the less amount they're going to withhold for federal income taxes. Okay? So in order to teach this concept about withholding for FIT for federal income taxes, we're going to look at what we call the percentage method in order to teach this concept. Now, to make these numbers clearer, I'm going to go to my Word document so that we can see this information a little clearer. Okay? So we call the percent method. Here we have a table. And it really depends upon how often you're paid, whether you're paid weekly, bi-weekly, etc. And this is focused on the number of allowances you're claiming. This is for one withholding allowance. So as I mentioned, the more allowances you actually claim, the less they're going to withhold from your earnings for federal income taxes. So next we have I'll come back to that. We have a chart here that shows the percent method of income tax withholding. So basically, depending upon how often you're paid, whether you're paid weekly, bi-weekly, whether you're a married person or if you're a single person, this is saying if you earn this much money, they'll take out this much taxes. If you earn this amount, they'll take out this much in taxes. So we pretty much have a table for any given amount that you may have earned for those different pay periods, whether weekly, bi-weekly, semi-monthly, etc. Okay, so let's go back to our person. So again, we have Joanne who earned $24.50 for the week. Remember, she is married and she is claiming two allowances. Okay, so because she's claiming two allowances, this takes $76.90 times 2. That'll give us $153.80. This is the amount we're going to subtract from Joanne's earnings to determine the amount of her taxable earnings. So again, this is the amount we're going to subtract from Joanne's earnings to determine the amount of her taxable earnings. And recall, the more allowances you claim, the less amount they'll take out in federal taxes. So Joanne earned $24.50. We'll subtract $153.80 from that based upon the allowances she's claiming. And so $2,296.20 is going to be the taxable amount for Joanne. Now, this is probably a little hard for you all to see, so hopefully you can see it okay. This is a chart for the married person. The full chart is here. I had to make it smaller, or just want to emphasize the chart for the married person. So again, the amount is $2,296.20, which falls in this category right here that says $1,606 to $3,073. The way it works, you will pay a tax of $198.40 plus 25% of the amount over $1,606. Again, the federal tax amount will be $198.40 plus 25% of the amount over $1,606. So for us, her tax amount was $2,296.20. We'll subtract the $1,606 to get a difference of $609.20. So we're going to take the $690.20 times 25%, add that to the $198.40. So for federal income taxes, the amount withheld from Joanne's earnings would be $370.95. So again, using the percent method, first we took the number of allowances she's claiming times 2, subtracted that amount from her gross amount to get her taxable earnings. Then based upon these tables, she's in the section right here. It'd be $198.40 withheld for federal income taxes plus 25% of the amount over $1,606, which was $690.20. So based upon the percent, the amount withheld from Joanne for federal income taxes, $370.95. Okay, so I'm going to stop right here, and then I'm going to come back with another video that will focus on the other deductions from gross to get to your